Hello and welcome to the Capital Markets on Channels Television. I'm Ididiong Iwang. The bullish momentum at the stock exchange switched into a higher gear as investors hunted for bargains following broadly positive corporate earnings released during the week. Activities recovered from the two-week slowdown as the value and volume of trades grew 20.0% week-on-week and 26.8% week-on-week respectively. The all-share index broke through the 30,000 psychological mark, a level last seen in June 2019, and closed at 30,530.69 points. That's the highest level in 15 months. Investors' interest in Nestle, Boa Cement, GT Bank, Dangote Cement, and Stanbic IBTC drove the benchmark index 6.4% higher, and that's its sixth consecutive weekly gain. The month-to-date and year-to-date returns for the index grew to 13.8% and 13.7% each. Performance across sectors was broadly positive as the consumer goods index topped the gainers chart, followed by the banking, industrial goods, oil and gas, and insurance counters. Well, let's look at some earnings now which contributed to the gains in the market during the week. Boa Cement released its financials for the 9-month period ended September the 30th, 2020, showing a 21% jump in revenue to 156.55 billion naira. The industrial goods giant operating profit and operating expenses increased by 15.7% each. Profit before tax for the period came in at 59.48 billion naira, while profit after tax increased to 53.56 billion naira, both indicating an increase of 18.5% and 23.8% each. Stanbic IBTC has also released the financials for the 9-month period ended September the 30th, 2020, showing an increase in performance in major indicators. The earnings show that the group recorded a 4% increase in gross earnings to 183.28 billion naira from 176.15 billion naira posted in the corresponding period of 2019. Net interest income stood at 56.257 billion naira as against 58.672 billion naira in 2019, while non-interest income grew from 81.939 billion naira to 98.453 billion naira in 2020. Profit before tax rose 11.22% to 76.865 billion naira, while profit after tax was higher by 19.10% to 44.366 billion naira. Meanwhile, telecommunications giant MTN Nigeria says its total revenue grew by 13.9% to 975.8 billion naira year-on-year in the third quarter of this year. However, highlights of its unaudited earnings results released to the Nigerian Stock Exchange shows that the telecom firm's profit before tax dropped by 0.6% to 211.6 billion naira, while profit after tax fell by 3.3% to 144.2 billion naira. Earnings per share declined by 3.3% to 7 naira 1 kobo. Meanwhile, the company says its mobile subscribers increased by 3.9 million to 75 million, while its active data users increased by 1.7 million to 30.7 million within the third quarter. Oil giant Total Nigeria posted a drop in its revenue by 32% to 151.7 billion naira year-on-year after reporting a mixed financial performance within the year. According to its 9-month results sent to the Nigerian Stock Exchange, the company's gross profit stood at 21.2 billion naira, down from 25.09 billion naira reported the same period last year. On the other hand, the company's pre-tax profits surged by 154.73% from its previous loss to 912.8 million naira, while profit after tax rebounded to 500 million naira within the comparative period. It has been an interesting time for traditional asset classes in Nigeria. Despite the apparent macroeconomic and policy challenges facing the country, the bond market has been on a gaining streak as yields continue to fall on the back of rising demand. Similarly, the equities market continues to enjoy tremendous buying interest as most investors are now turning to equities given the continuously depressing yield environment. During the week, the head of research at United Capital PLC, Olawale Olusi, put some perspective into the third quarter earnings season and the overall financial market performance. Let's take a listen.
I think, beyond all that has been happening in the economy, there's a peculiar case for, the Nigerian financial markets. And that has to do with the unorthodox monetary policy of the central bank. That has resulted in a huge amount of liquidity in the system and an extremely low yield environment. So what that means is that there's a lot of cash in the hands of both institutional and portfolio investors, as well as individuals, actually, HNIs, and those who can afford it. But investable assets, especially those ones that are safe or risk-free, they are very, very limited. Government is offering about 1-2% for treasury bills. 10-year bond yield is doing about 10%, 8 to 6%. A lot of foreign portfolio investors are stuck in Nigeria. They couldn't take out their funds. So because of that, they are left with no choice but to either buy the bond market or the fixed income instruments the way they are or at current rate, or they continue to bid for it, which resulted in continuous low yield environment, or go for assets that are a little bit more risky. And that's what has led to the rally in the stock market. Year to date, the Nigerian stock market closed about 8%, up yesterday, as of yesterday. Perhaps the best performing stock exchange in Africa, as well as if you compare it to emerging market and frontier markets. And then we've seen a lot of rally in tier one banks, among the cement players, as well as the tech giants in the economy, despite
Now,
all of the social rest that we saw last week.
yeah, and just as you have noted, of course, the equities market particularly seems to have benefited from the low yield environment in the fixed income market. Now, are investors just considering alternatives at this time, given that the Nigerian equities market is one of the best performing in frontier markets, as you just noted, at this time with a current year-to-date return of about 8%?
Well, I need to say that investors they aren't stupid. They are not just running to the equities market because they don't want the low yield environment in the fixed income market. They're actually very, very particular. Like I mentioned, there's a select universe of stocks that they are looking at. Like I mentioned, tier one banks. The bulk of the best players in that sector in the banking industry, their dividend yield is about double digits. Now, put a Zenith or a GT or even a UBA, side by side, 10-year bond. That's doing about 10 to 12% dividend yield. Meaning if you buy any of those stocks today, in about 6 months from now, you get about 10 to 12% dividend yield. Now, if you annualize that, that gives you about 24%. That makes more sense than putting your funds in government bills that are paying about 8% or less per annum. In fact, some 364-day bills are doing 2 to 3%. So I think those are the reasoning behind the rush for equities. Even some of the cement players, that's what we've continued to see. Dividend yields is one big driver of the demand for equities, beyond the need to avoid the low yield environment. I think
Now,
it's just investors following the money.
yeah, so are you saying that the current fundamentals of the companies support the current positive momentum we're experiencing in the equities market, or is it that a bubble is brewing in the market?
Okay, you can call it, a bubble. You can question the fundamentals of the Nigerian economy as a whole. But don't forget, even before the coronavirus outbreak that led to the crash in March, the Nigerian market itself has been considerably undervalued because of the preponderance of a double-digit yield in the fixed income market. So it just made more sense, as at this time last year and before, to stake your money in treasury bills of 6 months to 1 year at 12% or more, or even buy a bond of 2 year, 3 years that are doing 14, 16%. You know, so the stock market have been undervalued as a result of that. But with the crash as at March of this year, stock prices actually fell to record levels, and dividend yield became much more attractive. Now, if you want me to speak to the fundamentals, I will take the tier one banks, for example, where we saw their second quarter number, second quarter results. When we analyze it, despite the coronavirus outbreak, we expected, it was clear that so many of them were still going to be able to pay a decent amount of dividend, because even with all the pressure, their profitability remained very, very strong.
The Securities and Exchange Commission, in collaboration with the Financial Literacy Technical Committee and other stakeholders, set this week aside to mark this year's edition of the World Investor Week. The World Investor Week is being promoted by the International Organization of Securities Commissions with the aim of promoting investor education and protection. The Executive Commissioner of Operations at the Securities and Exchange Commission, Dayo Obison, spoke about this year's edition on our Business Morning Show during the week.
Capital will always seek destination. Even before NSAS, there was COVID-19. Before that, there was issue or scare around the falling oil prices, and before that, there will always be something. But the truth of the matter, if you look at different indexes, you see investments still keep going up. Now, what we are focused on doing is to make sure that the investing public is quite aware of investment options. The metrics they need to look out for in making a proper, well-informed investment decision. Now, two things will come out of this. There will be need for capital to rebuild. There will be need for capital for investment. There will be need for capital in every sphere. Just before I came on, I listened to Professor Kikumi talk, and one of the analysts from the capital market talk about likely outcome of all the destruction that has happened. Now, if these funds are going to be raised through the capital markets, which we sincerely hope they will be, which is more efficient they are, or they will be raised through the capital market, when investors are putting their monies in, do they understand what they're putting their monies into? Increasingly, I read a report over the weekend, for example, about the increase of online scams and Ponzi schemes in the US. I mean, these are peculiar times. Things like this will always come up. But the first way to even empower and to even close out those kind of, should I say, ill-informed decision or wrong decision is to invest the public, which is one of the things we are doing now. We will continue to do at the Securities and Exchange Commission.
So what are the key messages for this week, for the World Investor Week? What are the key message there?
So one is to project further the basic tenets, the basic things to know about investing, and to let the investing public know that risks are inherent in every investment opportunity. You need to be well aware of those. That is why on all prospectuses or any documents that is issued, it's always written there in red that you should always seek advice from a fund manager or an accountant or a CMO or as a capital market operator to guide you right. So the major message for this week is to project the basic tenets of investment, encourage mobilization of savings and investments, encourage people to save and invest. Those are the key things we're projecting this week.
Now, you talked about the Ponzi scheme, and we are all aware of the activities of the promoters of this scheme in the country and how much havoc they have wreaked on innocent and indeed ignorant Nigerians. The Commission had earlier announced plans to commence the regulation of digital assets transaction. Where is SEC in these regulation plans?
Okay, so I'll start from the second offshoot, which is the digital assets. So you will remember about a month ago, the Securities and Exchange Commission, we came up with a firm stand that we were looking more into the digital asset space. Now, before now, what had happened was there still are a lot of, should I say, digital asset managers or digital operators, and and the main, should I use the word excuse, or the main reason they were given for not coming under regulatory purview is that there was no grand position or a firm position from the regulators. Now that has been made known. That's what is going to follow that very quickly in succession is the incubatory guidelines, which is quite ready, but we just need to do a couple more of education for the users and the investors, and even for our counterparts and other agencies as well. So before we roll that out.
Well, Capital Markets continues when we return from this break. Do stay with us. Welcome back and thanks for staying with us on the program. After weeks of protests followed by a series of violence, vandalization and destruction of property, the economy is still counting the losses that have not only threatened public peace, but have also brought dire consequences on livelihoods and businesses. Although overall macro headwinds are still evident as the economy grapples with the consequences of the COVID-19 pandemic, the recent disruption of economic activities have also introduced more negative impact on an already awful situation. The investment landscape keeps getting tougher as businesses struggle to stay afloat amid highly hurtful macroeconomic conditions. Indeed, the year 2020 has introduced much complications in properly predicting economic indicators following the impact of the COVID-19 pandemic and a series of other security concerns. The Chief Investment Officer at AfroInvest Asset Management Limited, Robert OMOTUNDE, spoke on investment alternatives that investors can consider to navigate all of these challenges. He was speaking on our Business Morning program. Do take a listen.
I think the most critical reforms that the government should pursue right now is how we can de-risk this economy. Now, there's so many risk factors that investors want to consider, especially when you look at the quantum of investment that the country needs for us to get to that path of sustainable double-digit growth. Now, we have a situation where foreign direct investment has been significantly hit, for over 10 years right now. And we are at a level that is, at best called abysmal, because the level of investment has been way below what all other neighboring countries are even getting within Africa. So if we must attract more foreign direct investment into the country, the market is here, the opportunities are enormous. But when the economics is also not right, or the risk environment is so elevated, investors will want to fly over you.
How do we begin to de-risk?
So one of the things that government can do is, part of all these, market reforms that we've been mentioning. Market reforms, a situation where government does not want to hold tight to, pricing of products and services, especially when they are very essential and critical to the growth of your economy. So that's one way. The other way, it's your foreign exchange policy. If you look at what we've seen since the COVID-19 pandemic, kudos to the central bank this time around, to be honest, because we have not seen the repeat of what we saw in 2016. Nonetheless, we still have shortages in terms of supply to that foreign exchange market. And you can sympathize with the central bank because when you look at the level of reserves today at $35 billion, there are parts of that reserves that, if the central bank has to take the hit today, talk about OMO bills that have been sold to foreign portfolio investors, that's about $11 billion, part of that reserve. If you look at swap transactions with with different banks by the central bank, that's even amounting to up to $8 billion. So when you take those out of the current reserves that we have, you barely have about $16 billion of reserve. So again, the central bank is watching what it has in terms of, the storage for the reserves. And that has been the basis for rationing foreign exchange. And that is also impacting on, how investors perceive us. The consequence is that we've seen a significant drop in foreign portfolio investment. As at Q2 data, we had only about $382 million. Compared to first quarter of $4 billion. In fact, in 2019, we had a total of about $16 billion of foreign portfolio investment. And that's the hot money we say, but it has always supported our reserves. But now it's even drying up. So what that means is that the only source of accretion to the reserve will be oil. And then oil prices are also depressed. So it's not looking so good, especially when you look at the outlook for foreign exchange. So these are some of the reforms that we can pursue to make our economy attractive.
Now, talking about the foreign exchange market, where do you see the equilibrium level of exchange rate, settling in the near term?
It's a tough call, to be honest, and that is given the fact that the central bank, does, have a lot of say in where the exchange rate will settle. Today, if you see the central bank pumping as much supply into the market, to accommodate some of the demand that we have, you will see that the pressure on at the parallel market will drop. Right now, we have about 460 naira to the dollar at the parallel market level. But it could get worse if we don't have much accretion coming into that reserve. And look at our import bills, if you study what the second quarter data for trade, you will see that we had about $22 billion in terms of import, and our export was only about $16 billion. So net, we had a trade deficit of about $6 billion. If that trend should continue, what you would then see is, and with the depressed state of oil market, what you would then see is significant depletion of that reserves. And if the reserve should drop further at the level that it is right now, the consequence will be higher exchange rates. But I think the fair valuation right now, given some methodology that I've always mentioned in this studio, looking at the money zero maturity and the reserve itself, it suggests that we should be at about 450 to 460. But that's looking at what it says at the parallel market. It's a different ball game, what we have at the I&E FX window.
So which sectors of the real economy will be most attractive in terms of government investment going forward, given some of the reforms, the government is trying to do at the moment?
Well, I think that, so there's still a lot we can tap in the oil and gas sector, for example, especially at the upstream. We are in a situation where the world is talking about energy transition. In the next 10 years, 15, 20 years to come, oil may have lost its relevance. But now, we can still tap as much as we can tap. We talk about production in Nigeria still hovering around 2 million barrels per day since possibly the 1970s. How do we improve this? What we can do is to invest more in that upstream sector. We should make it attractive so that we can get as much as we can get before the reality, stares us in the face and what we have underground will no longer be valuable.
We have to continue to focus on oil when we're talking about
I'm just saying that
diversifying.
that's a low-hanging fruit that the government
just to capitalize on that.
Yeah, the government can look at, in the downstream space, once we've liberalized, we're going to unlock so much investment in that sector as well. Power is one that I've mentioned over and over again because it has a lot of, significance to the growth of a growing economy like this. Then the other side that you can look at are, investments in agriculture. We focus too much on primary state of agriculture. Let's think about the value addition that you can, begin to, make in that sector that will help us to generate even more foreign exchange earnings. The real estate is another sector. We talk about deficit of, 17 million housing units that are in deficit, but how much of investment are we seeing in the real estate sector? These are, critical sectors that the demand exists for us to be able to, unlock growth.
Well, that is on the program tonight. Thank you for watching. I'm Ididi Ongiwang. Do stay safe.